Alright, pay close attention because this is one of those critical moments where ignoring warning signs can cost people everything. History has repeatedly demonstrated how this scenario unfolds. Every significant collapse in crypto never happens suddenly or out of the blue. It doesn't start with a headline, but quietly begins with stress building behind the scenes, liquidity mismatches, cracks in confidence, and the dangerous assumption that this time is different. It never is. At this moment, signals are flashing that most of the market either misses or chooses to ignore. Here's the uncomfortable reality. Most people don't lose their crypto because prices drop. They lose it because they trusted the wrong infrastructure. They placed faith in custody instead of ownership. They relied on platforms rather than the underlying math. When the system breaks down, many realize far too late that an exchange is not a wallet and an IOU is not the asset itself. This lesson has been painfully repeated countless times. Mint, Gox, Quadriga, Celsius, Voyager, FTX. All different names, but the same disastrous ending. The frightening part is that before every one of those failures, there were publicly visible warning signs that people simply refused to acknowledge. The crypto market today exists within a fragile macroeconomic environment. Liquidity is tight, risk appetite is highly selective, and capital is concentrating instead of diversifying. This is precisely when structural weaknesses become exposed. When money flows freely, bad balance sheets remain hidden. When conditions tighten, leverage turns deadly. This is exactly the point when exchanges, custodians, and intermediaries face their true stress tests. Not during bull market euphoria, but during periods of uncertainty, massive withdrawals, and collapsing confidence. Confidence is everything in this industry. Exchanges don't fail because prices fall. They fail because users simultaneously rush to exit and discover that the reserves are neither as clean, liquid, nor as segregated as promised. Once trust is broken, size and brand dominance no longer protect. In fact, history proves the opposite. The larger the entity, the more systemic damage when cracks appear. This is why the current conversation should not focus on chasing gains, rotating memes, or trying to outsmart the market with leverage. It's about survival first. Because if you don't survive the infrastructure risk, nothing else matters. Your entry points, your targets, your long-term convictions, they all become irrelevant if your assets are frozen, halted, or trapped inside a failing platform. Over time, the biggest blind spot I've observed is how people underestimate non-price risk. They obsess over charts while ignoring custody. They debate narratives while overlooking counterparty exposure. They assume regulation, branding, or popularity guarantees solvency. It does not. Crypto was built to eliminate the need for trust, yet most participants reintroduce trust into the system through centralized choke points. That contradiction is where most losses originate. Furthermore, this is not just about exchanges in isolation. A broader backdrop is forming. Stablecoin reliance, opaque balance sheets, rehypothecation, and assets propped up purely by speculation rather than utility. These factors amplify damage when stress hits. When one part of the system wobbles, shockwaves travel rapidly. We've already seen how contagion spreads quickly when liquidity dries up and forced selling begins. This next market phase will not be kind to everything. Cycles don't reward excess forever, they cleanse it. When that occurs, the difference between those who emerge intact and those who don't usually comes down to preparation, not prediction. You don't need to know exactly what will break to protect yourself. You need to understand how things break and act before panic forces your hand. This video focuses not on fear for fear's sake, but on awareness, understanding where the real risks lie in this market today. Why exchanges are always the first domino in systemic events, and why self-custody becomes critical precisely when people feel most comfortable ignoring it. By the end, you will have a clear framework for thinking about exposure, risk, and protection, not based on hype, but grounded in how crypto failures have historically unfolded. Most people only ask the right questions after something goes wrong. The smart ones ask them beforehand. Let's dive deeper. To truly grasp why exchange risk is rising again, you must zoom out beyond crypto headlines and examine the macro structure underpinning this market. This is where most people lose the plot. They believe collapses stem from a single bad actor or one unlucky event. They do not. Collapses are caused by pressure building throughout the entire system until the weakest links snap. We are now in a phase where global liquidity is no longer freely expanding. Central banks act cautiously, capital is selective, and risk assets are forced to justify their existence. This matters because crypto, despite all the hype, remains deeply connected to global liquidity cycles. When money is cheap, speculation thrives. When money tightens, only assets with real demand and usage survive. Everything else becomes a liability. Exchanges sit directly in the middle of this pressure. They depend on constant activity, inflows, and confidence. The moment users slow down, withdraw more than they deposit, or question reserves, the business model quickly becomes strained. Here's the uncomfortable truth many don't want to hear. Proof of reserves dashboards do not solve this problem. They are mere snapshots, not guarantees. They do not show liabilities, rehypothecation, or what happens under mass withdrawal conditions. History is brutally instructive here. Every major exchange failure follows the same pattern: strong branding, heavy influence, deep ecosystem integration, followed by a trigger, sometimes a leak, a rumor, or a macro shock, that causes users to test the system simultaneously. That's when reality surfaces, not during normal operations but under stress. Stress reveals the truth, comfort hides it. Meanwhile, the broader crypto market still carries enormous dead weight. Thousands of tokens exist primarily because speculation keeps them alive, not because they solve meaningful problems. During expansion phases, this does not matter. Liquidity masks inefficiency. But during contraction phases, capital becomes ruthless. It flows toward clarity, utility, and survivability, and away from narratives lacking independent strength. This explains why the assertion that 99% of cryptocurrencies will vanish isn't extreme but logical. Markets do not need endless copies of the same idea. They require infrastructure that functions at scale, under regulation, scrutiny, and across cycles. Everything else is eventually flushed out. This doesn't mean prices drop to zero overnight, but that relevance fades, liquidity dries up, and exit doors shrink over time. Another common mistake is assuming exchange risk and asset quality are separate conversations. They are not. Weak assets exacerbate exchange risk by collapsing faster, losing liquidity more rapidly, and pushing platforms into precarious positions. When exchanges hold illiquid assets, incentive tokens, or artificially supported markets, their margin for error shrinks significantly. A single shock can cascade into forced selling, halted withdrawals, or worse. Stablecoins also lie at the heart of this tension. They are the plumbing of crypto markets. When confidence in stablecoin backing or liquidity weakens, exchanges feel it immediately. Pair liquidity dries, spreads widen, and volatility spikes. Stablecoins need not fail outright to cause damage. Doubt alone can slow withdrawals, distort pricing, and stress reserves. This is why crypto risk management cannot be reactive. Waiting for confirmation traps people. By the time headlines verify a problem, exits are crowded and options limited. The market rewards those who position early, quietly, and rationally, not those who panic late. None of this requires predicting a specific collapse. That's the point. You don't need names, dates, or rumors. You need pattern recognition and understanding of where fragility lives and why it always appears in the same places. First, exchanges, leverage, speculative assets, opaque structures. Looking forward, the question is not whether crypto survives. It will. The question is who survives. Survival in this phase demands discipline, exposure management, control, and acknowledging that the most dangerous risks are the ones people ignore when markets feel calm. Now, here's where practicality comes in. Awareness without execution is useless. Understanding risk doesn't protect you. Positioning does. When it comes to crypto, two types of exposure are widely misunderstood: exchange exposure and asset quality exposure. Mismanaging these renders macro insights meaningless. Starting with exchanges, exchanges are tools, not vaults. They facilitate transactions but don't safeguard long-term wealth. Treating exchanges like banks or wallets introduces a single point of failure into a system designed to eliminate those. The irony of crypto is that technology solved custody, but humans reintroduced risk through convenience. The first uncomfortable rule is, if you don't need funds on an exchange, they shouldn't be there. This doesn't mean exchanges are evil or unusable. They are necessary components of the ecosystem, but should be treated as temporary bridges, not homes. The longer assets remain on exchanges, the greater exposure to risks unrelated to price, operational risk, counterparty risk, regulatory risk, liquidity risk. Structurally, exchanges are most vulnerable during periods of declining volume and rising withdrawals, when revenue decreases while liabilities increase. This explains why stress is invisible in bull markets but appears when activity slows and confidence falters. An exchange doesn't need to be fraudulent to fail. It only needs a mismatch between user expectations and actual availability. Asset quality is where many sabotage themselves unknowingly. In every cycle, most tokens exist purely for speculation. They generate no demand outside trading, solve no real problems, and lack a user base independent of price appreciation. These assets perform well only when liquidity expands and risk tolerance is high but collapse swiftly when conditions tighten. Hence, reducing exposure to pure speculation during fragile phases is not bearishness but selectivity. Assets surviving multiple cycles share key traits: real-world use cases, institutional integration, regulatory clarity, infrastructure relevance. They aren't immune to volatility but less likely to vanish completely during resets. Infrastructure-focused assets behave differently than hype-driven tokens. They face different risks, timelines, and adoption paths. That doesn't make them absolutely safe. Nothing in crypto is, but it alters the probability of long-term outcomes. Another critical mistake is assuming diversification always reduces risk. In crypto, diversification across highly correlated speculative assets amplifies exposure. Holding many assets dependent on the same liquidity and speculative flows is concentration disguised as variety. Real risk reduction comes from fewer assets with clearer purposes, not more assets with weaker foundations. Technically, structure matters during fragile times. Liquidity levels, support zones, and volume patterns become more important than narratives. Assets with deep, consistent liquidity and established trading ranges absorb shocks better. Thin books and artificial volume do not. In stress events, there is no mercy. Liquidity disappears where people assumed it would always be. This is why just sell if something happens is a flawed assumption. That works only if others aren't trying the same thing. During real stress, withdrawals delay, trading halts, and slippage explodes. Reacting isn't a strategy. Being positioned beforehand is. The takeaway: minimize unnecessary exposure. Be ruthless on asset quality. And recognize that most catastrophic losses in crypto stem from structural blindness. People lose not because of wrong market calls, but because they were in the wrong place when pressure hit. Zooming out, if stuck in short-term fear or price action, you miss the true purpose of cycles. Crypto moves in violent expansions and brutal contractions. Each contraction's core function is to remove everything unworthy of existence. This is not opinion but how capital markets mature. Every major cycle follows the same script. Innovation brings opportunity. Opportunity attracts speculation. Speculation breeds excess. Excess collapses under its own weight. When collapse occurs, narratives shift from how high to what survives. The real winners of the next cycle quietly position while others process losses. Many misunderstand long-term positioning. Long-term doesn't mean holding everything and waiting. It means aligning with assets and infrastructure that remain relevant after the noise fades. Survivability matters more than upside in these phases. If something can't survive stress, it doesn't deserve capital regardless of how exciting it seemed during expansion. Historically, assets emerging stronger post-downturns share one trait: they become more embedded in real systems while others fade. During downturns, hype disappears but usage remains. Infrastructure remains necessary despite falling prices and shifting narratives. Cycles favor networks serving functions beyond speculation. Comparisons matter. Not all crypto assets compete in the same space, even if they trade on the same exchanges. Some aim to be digital commodities. Some are speculative experiments. Others are infrastructure layers integrating with existing financial systems. Treating them equally is a mistake. Their risk profiles, timelines, and failure modes differ. Assets surviving multiple cycles share persistence. They build while attention fades, integrate while others chase trends, endure regulatory scrutiny rather than avoid it. This does not guarantee short-term price gains, but dramatically increases long-term relevance odds. Cycles also reshape liquidity control. Early cycles were retail-driven. Later ones increasingly involve institutions, custodians, payment providers, regulated entities. This matters because institutional capital behaves differently. It demands clarity, compliance, infrastructure, doesn't chase memes or tolerate chaos. It favors scalable, scrutiny-resistant systems. Downturns are selective. They filter markets. Projects relying on constant inflows collapse when inflows cease. Projects with real demand operate despite price disregard. Capital follows this slowly, then rapidly. Another harsh truth: most underestimate how long cleansing phases take. They don't resolve in weeks but unfold over months or years. Impatience and overexposure are punished. Disciplined positioning rewards quietly. The biggest beneficiaries of the next expansion are usually cautious, selective, and boring during contraction. Custody becomes inseparable from long-term thinking. Holding through cycles means prioritizing ownership over liquidity. True long-term holders accept short-term friction to avoid existential risk. This mindset separates survivors from casualties. What you decide now isn't which asset pumps next, but whether you'll be standing when the next phase arrives. That's an entirely different question, requiring humility, restraint, and acceptance that the market owes no easy rides. Cycles, volatility, and headlines will continue, but the underlying market structure becomes clearer with each reset: fewer assets, stronger infrastructure, higher standards, and less tolerance for nonsense. Understanding this stops noise chasing and aligns you with durability. Stripping away noise, headlines, and emotion reveals a simple core lesson. Most people don't lose crypto because of the wrong coin. They lose because they ignored basic risk discipline. They assumed convenience was harmless, platforms were safe by default, and they'd have time to react. History shows those assumptions are punished when stress hits. The first takeaway: custody. If you don't control the keys, you don't control the asset. That's not a slogan, it's a rule. Exchanges can pause withdrawals, platforms can freeze accounts, regulators can intervene. None of this requires price movement. A strategy relying on perfect functioning under pressure isn't a strategy, it's gambling. Long-term crypto survival starts with ownership, not optimism. The second takeaway: exposure. You don't need to eliminate exchanges entirely to manage risk. Exchanges are tools with specific use cases. Use them for buying, selling, rebalancing, then reduce exposure. Keeping only what you actively need on exchanges reduces vulnerability to uncontrollable events. This isn't paranoia, it's acknowledging how failures actually occur. The third takeaway: asset quality. Speculation isn't a long-term plan. Assets relying solely on hype, leverage, or artificially supported liquidity perform best when conditions loosen and collapse fastest when conditions tighten. Markets don't reward excess forever. They eventually force capital to choose. Utility, durability, and integration matter far more than narratives. Another critical point: behavior. Panic destroys more portfolios than poor analysis. The most hurt during black swan events are those who make decisions under stress. When fear becomes visible, options are limited. Preparation always beats reaction. Quiet positioning before pressure escalates is far more effective than fleeing when exits are crowded. Cold storage fits perfectly here. Cold wallets aren't extreme, they remove unnecessary risk layers. Set them up carefully. Interact minimally. Treat them like vaults, not checking accounts. Never store seed phrases digitally. No screenshots, notes apps, cloud backups. Every case of compromised self-custody I've seen traces back to convenience overtaking discipline. Physical backups exist for a reason. Use them. Stay alert to social engineering. Scams now are sophisticated, targeted, automated, and AI-powered. Fake profiles, impersonation, comment traps everywhere. No legitimate entity will ask for keys. No real opportunity requires urgent, secretive action. Pressure to act fast and privately is your cue to slow down. Zooming out, the market is transitioning. Excess is challenged. Weak structures are tested. This creates fear, but also clarity. The goal isn't predicting every move, but positioning so no single failure, platform, or shock can wipe you out. That's resilience in crypto. If you do this, volatility is manageable. Headlines become noise, and cycles become something you navigate rather than control you. Most won't do this. They'll remain overexposed, overconfident, underprepared until forced to act. Don't be one of them. Review your exposure. Know where your assets really live. Question assumptions carried from easier market times. Remember, boring discipline usually beats emotional conviction long term. Finally, a critical note. Everything here is educational, not financial advice. I'm not telling you what to buy, sell, or hold. You are responsible for your own decisions, research, and risk management. Do your own research, understand your situation, and never place yourself where a single event can define your outcome. That's how you protect yourself.